The following is a pre-recorded show. Welcome to Winning in Retirement with your host, Brian Akers, certified financial planner professional and founder of Akers Financial Group. Now, helping you win in your retirement, here's Brian Akers.
Welcome to Winning in Retirement. I'm your host, Brian Akers, certified financial planner practitioner. I'm president and founder of Akers Financial Group, and we welcome you to our Winning in Retirement radio podcast. Today is a good day. It's a great day because we're teaching the following topic. It's called the 4 Principles of Investing. Absolutely a must listen. You need to spend your time listening to this show today or on a podcast or through our website. Listen to our show to understand some basics of investing so you can get started, continue investing, or maximize your ability to invest for all of your goals in life. Today's show, I brought in expert Paul Franco from Akers Financial Group. Good morning, Paul Franco.
Good morning, Brian. How are you?
I'm pretty good, man. So we've been working together since 2017.
Yeah.
You're one of those guys I was coaching as a 7th grade or 8th grade soccer player, and I said, I want him to work for me someday.
Yeah, it's since 2017, but I've known you a lot longer.
Yeah, a long time. But what's great is that you got your MBA, you got everything geared up, and these last 6 years have flown by. You become an expert here at Akers Financial Group, and we look forward to having this show with you on investments. Now, it's called the 4 Principles of Investing, and then I added some W's. Do you know what the 4 W's are there, Paul?
It may be why, where, what, and when.
That sounds like the right thing. I was going to make fun of W's, but then all of a sudden...
There's a lot more W's we could use, but...
Yeah, the winning in retirement, right?
Winning in retirement, yep.
Yeah, that's not that funny of a joke. It's a Saturday morning, but we thank you very much for listening to our show. All right, so we're going to get started on this. Akers Financial Group, we welcome you. The reason we welcome you is this. We are a financial planning group. We believe people need to do planning, need to think ahead before they just go ahead and do something. Don't just buy what someone presents. Know why. So the very first quarter, it's about why. Why are you investing your money? So Paul, why is this so important?
Yeah, it's such an important topic, talking about your why, because that really governs all the different decisions we have to make after that. A lot of times when we talk about purpose, we have to work through what is the reason for why you want to invest. Is it shorter term goals? Are we trying to save for a house? Are we ultimately saving for retirement? Are we trying to set a legacy for our kids, grandkids? There's so many different examples, but the very first important thing you have to look at is that why. That's the first thing that we ask.
So when you walk in the door and you come in, we have our meeting. We offer this free hour of time. We sit down, go over what you want to do. We start out with, hello, so why are you here? What are your questions?
Right.
And so while you're here, people have all kinds of different answers, right, Paul?
Absolutely. Yeah, it's we try to work through the why in the sense of there's so many different reasons that everybody comes here. Mm-hmm. So, and we're not going to offer just a cookie cutter, here's the answer, without getting to know you and why you want to invest a certain way.
Yeah. So the why always ties to the purpose. So imagine when you give your money purpose, you then can invest with that purpose, that why in mind, and it makes it very easy to decide the right way to implement your investment portfolio over time.
Right. And it's actually not too uncommon where somebody comes in and they don't know their why. They've just been told, whether it be from family or something they read or something they listened to, that they should save. And that's their purpose.
Yeah, they're told to do it, and then some people listen, but most people don't.
Yeah.
I mean, if you look at the total of America, they don't all save. Mm-hmm. A small amount save. If all of America saved properly, put something away for their retirement, threw money to their own future, then they would be okay financially. The sad part is most people listening to radio shows that don't do any of the investing, they're going to do the investing in the future, but they don't even have any motivation to get started. So this purpose, this why, does tie into your motivation. It makes you give up the things you're doing right now where your money's just flying out the door, and you say, I'm going to live off of less than I make. I'm going to keep some of that money. And the reason why is because I want to have a future. I want money when I can't work. I want money to buy a house, to buy a car, to pay for college, to buy a second house. There are reasons and purposes we need money. And what is your reason to save? What is your reason? Do we know?
Right. Yeah. it's not also uncommon for just somebody to start saving into just a regular bank account, and just because that's what they've been told. They've built their emergency fund, and now they've just kept adding and adding to it. I just had a case like that recently where they have these other goals where they want to save to retirement. They want to actually buy a house in the next few years. But what they've been doing is just saving to a low yield regular savings account.
Yep.
And there's a lot of different options out there, which I know we'll get into later, but different strategies that we can deploy to help better suit that goal you have, and ways to invest that way.
Yeah, so we at Akers Financial Group start with your unique financial fingerprint, because everyone's unique in what they have done in their career, what they have done in their savings life, what kind of pension, Social Security, debt versus budget versus incredible income job, whatever is going on in their life. And so we take that unique financial fingerprint and then we build on it. We invest money from the why to where, into what, and to know when is the key to this process of actually investing for your future. This show is designed for you to think about this process to invest and to actually do it. Investing is a way of life that you all must consider and implement into your own finances for your own financial future. So you're driving along, or you might be sitting at home or out in the workshop or somewhere listening to the show, and you're thinking, all right, so why should I invest money? Now, what happens is some people, a lot of my clients, do extremely well in their life, very well in their career, and they're going 1,000% in one direction at their job, and their financial planning is something in the aftermath, where whatever's left is left, they save it on the side. It's not the primary goal leading them, which I think is okay.
You see it all the time, absolutely.
I think it's okay for them to not have it the only thing in their life, because they do need to think about their career and go for that. And then what happens, though, is we need to have a plan as they do well in their career for that money to be set aside for every goal that makes sense for them. So they have the cash to do the things they need, have the retirement in the future so they can stop and be financially independent. And we got to do a lot of things. And so understanding that these opportunities at your work, opportunities in Roth IRAs, opportunities in just building your savings, you have to make them happen. They don't just happen without you.
Yeah. It's all goes back to that idea of the why, and that all governs the what and the where and the when for each of those W's.
Yeah, I had this one client. They basically they work hard. They start a small business, and when you run a small business, that's your life. It's everything going on. And then the key thing is that after a while, they're like, we're not quite sure where all the money's going, but my net worth isn't moving up. And I try to teach people about net worth being a great way to judge how you're doing. Now, the business value increases, which is great, but how about your savings? You have some money put to retirement, money put aside to where you'll have something in your future.
Right. Yeah, and that business owner, and I don't know the exact case you're referencing, but broadly, this idea where you've set up this business and you've grown it, and now you're thinking about retirement later. What's the exit strategy? Is there somebody that's going to buy you out? There's a lot of different concepts and ideas you have to work through, especially in that specific scenario.
So I was thinking about different people with different levels of income. It's almost the lower income you live off of now, it's easier to retire early. It's easier to retire because your need is so low. Mm-hmm. That means if you make $50,000 a year and you want to retire on that, that's a lot easier because Social Security provides maybe 80% of the money that comes from the net. So what I mean by that is if you make 50, you pay taxes, then there's a net, say in the high 30s, you're going to make $25,000 probably from Social Security. So that fulfills maybe half of your gross income just from that. And then you start adding a little bit of savings before you know it, you met your need.
Right.
But if we all of a sudden make that income $200,000 or $300,000 or higher, meeting that goal isn't as simple as, Social Security's got me, or if I just do 10% at work savings, none of that's going to meet that goal. Right. And so the reality is the more successful you are, the more you need to pay attention to what your long-term purposes are and make sure that your money is going to work as hard as you are.
Yeah, it's all about that cash flow concept where what's the need we're going to need in retirement? even somebody that makes a high income, their need may be lower in retirement, but it's working through that in those meetings, trying to work through what is that need going to be and what's the strategies we can deploy so that we can meet that need. Because Social Security isn't going to do it. The pension, there's not many out there left outside of government and a few private sector. So we have to self-fund retirement wherever we can. And that's through Roth IRA, through, what you can do through work, 401k, 403b. There's all different ways that we can work through that goal.
Yeah, so knowing the purpose behind what you want to do. This is setting goals. Now, if you start a year out, you always have goals and you want to write them all down. You're ready to get started. Then the reality is, where do I start? Now, financial planning is what we recommend. Financial planning is where we say, where's your money going? And what can we do? And we do the scenario out and we come back and say, do these things now and build your fundamental financial plan. And then we add on top of that, as we grow further and further, the plan into everything that you want to accomplish.
Yeah. And to take that further, you can set short-term goals, mid-term goals, long-term goals, and try to work those into the financial plan. And that's going to govern how we can invest that money and how you should invest it.
Absolutely. And that's what the whole show today is going to be about, all those pieces of taking that purpose of what we're doing and building on that into actually recommending what you should be doing. Now, advice is individual. It's individual in nature because it's planning. A planning approach is where the advisor is going to ask you a lot of questions, want copies of a lot of things so they can know who you are.
Yeah, and some people don't bring that all into the first meeting. It takes a few meetings to get that, and that's okay. But we are nosy. We're going to ask all those questions. So it's a good thing, though.
Absolutely. So Akers Financial Group, we're local. We're independent. We don't report to a big company on Wall Street. We report to you. We do have offices in Forest Hill and Lutherville, on clients all around the country, even a few around the world. It's so easy to begin winning in retirement. Do you know that some of our clients, actually, when they move away, they stay with us? Actually, most of them stay with us. And the reason is that we built that plan for them to accomplish the goal out of state, and then we keep that relationship going. And that's a real honor of ours, is to be able to help those clients through all those retirement years, wherever they may go. And that's why we have license in so many states right now. It's very enjoyable. So it's so easy. So you can begin winning in retirement. Just go ahead and give us a call and schedule your free meeting with one of our team of advisors. Call us at 833-WIN-RETIRE. That's 833-WIN-RETIRE. And give us a call on Monday, and we'll schedule a free in-person or Zoom meeting. Go to akersfinancialgroup.com or call us at 833-946-7384 to start planning for your retirement now. Where do you save your money? And where should you save your money? We will explain in just a moment.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Yes, welcome back to Winning in Retirement, a radio podcast put on by Akers Financial Group. I'm the host, Brian Akers. Here with me today is Paul Franco. We're both certified financial planner practitioners from Akers Financial Group, and we work out at Akers Financial Group in Forest Hill and Lutherville are our main offices, and then we do virtual meetings with clients all around the area. Akers Financial Group is built on financial planning. Planning first, then basically tells us how to implement. This show is called 4 Principles of Investing, and that is going to lead us to actually implementing what we need you to do when it comes to putting your money away and saving. Now, I've been holding Paul back in the first quarter. He really wants to get deep into the next subject, and that is this, Paul. It's where do you save your money and where should you save your money? So this second quarter is all about where, and I know you're ready for the where.
Absolutely, yeah.
And so go ahead, Paul.
Yeah, it's, this idea of where is really getting into the nitty gritty on, there's different sources of ways that we can save. And so we have to work through that in the plan and determine, well, how much should we be saving to an emergency fund? How much should we be saving to work? And how much should we be saving to Roth or to life insurance? And we have to work through that into the plan. A lot of that's governing through what the time horizon is. I just had an example of a client of mine where she just came into some inheritance. Now, the very first thing I asked her, she was almost stressed when she came into that meeting. She had never had that kind of money before. She was kind of leaving it in a bank account. She said, what should I do with it? The first thing I ask is, well, what do you want it to do for you? What she wanted to have some of it, saved towards her retirement, and we're limited in how much we can do to that. She wanted to have some college savings for her kids. And then ultimately, she wanted most of it to go towards buying a house in the next few years. And so knowing that in that specific example governed how we could invest that money. The money we need shorter term for the house, we did buy short-term CDs, treasury bills, something, lower risk. You can call it risk-free, and, collecting a higher yield than your regular, they call it high yield savings, Brian, but they give you 0.02.
Well,
0.02%.
It's almost like a government, when they have a government bill where they write it, whatever it says isn't what happens. So high yield savings, you need to run away. The idea is this: you need your money to make money for you.
Right.
And so what you have there is a case where a person has an inheritance, and we got to plug that into a regular financial plan.
Absolutely.
So what I try to do is guide people that have an inheritance into, let's do something that person wants. The person that gave you that money wants this to help you with your life. This isn't designed to have a good weekend or a good month or a good year only, but to have a good life. This money was a lifetime of savings by someone who did not spend it, saved it for you. That's a big deal, and we need to treat that inheritance like a big deal. So the purpose behind the gift is they want you to use it to make your life better. So what we want to do, in my opinion, is do a financial plan, see where it fits in, so that we know how much to put on a house, how much to filter retirement. And then we do a checkup of the basic numbers we have to calculate. One is, do we have enough money for retirement? Second is, do we have enough money when it comes to getting ourselves out of debt by retirement years? And then is there other things in the plan, such as too much personal debt we just got to knock out to make things work? So when it comes to the purpose, then all of a sudden is, where do you put this money? The planning helps us with the where. And what happens is we also have to investigate all your options you have. And that all starts with a job, right, Paul?
Sure. Yeah. And I couldn't agree more with what you said. And with that talk on working through a job, that is the very first place you can look, because a lot of times they offer you a match if we're focused on retirement. And we absolutely recommend you should be maximizing that match at a minimum. And then if retirement's a goal and it's sooner maybe than later, depending on what that need is, if you get a 5% match at work, you might still need to do more. Mm-hmm. But that's one of the first places we look. You're absolutely right. Yeah.
All right. So learn this mantra: maximize your match. Maximize your match at work from the first day of work. So you get a new job, pop into the job, they throw you a folder at you. A lot of people check a couple of boxes, they sign, and they put the minimum in. The minimum is match. You need to make sure you maximize the match the company gives you. Do that and live off the rest of the money.
Right. And regardless of if you're going to be thrown a bunch of different investment choices as well, just first things first, contribute the match. We can work through the investment choices afterwards.
We can make the changes. If you need to, you just call Akers Financial Group. Right when you get that paper thrown at your desk, you call us, 833-WIN-RETIRE. Go, I'm going to retire. I'm going to win in my retirement. I'm going to call Winning in Retirement right now because I got in paperwork.
Right.
What do I do? And then we can help guide you on your choices at your work. Understand that our most successful retirees that retire early, they put the maximum in from as early as possible, and then they put the money to work in the market. They're not a passive investor. They don't go all stable value fund. They don't put in just the minimum. They maximize it. These are the people that have $2, $4, $5 million in the IRAs at retirement. It's not because you put in $4 million. It's because you put money in and you let it have time to grow.
Yeah, it's the beauty of compound interest.
Now, your choice of pre-tax versus Roth, that's a very important choice at that moment, right?
Absolutely. And I would say that if we're going back to that very first folder that you get, that's another piece that we can always change if we have to adjust it from pre-tax to Roth or vice versa. To get started, if it's a 5% match, if it's a 2.5%, 3% match, just minimum contribute that, and we can always fine tune from there. But like you're saying, that this idea of Roth is something we like to go towards. want to work through how much we should have tax free in retirement, and that's through the Roth and having a Roth 401k or Roth 403b. And then on top of that, there is some portion that will be pre-tax, because imagine, even if you're contributing to Roth in your 401k plan, you're going to get a match, and that match is usually pre-tax. Now it's essentially free money, but now you've built a Roth balance and a pre-tax balance in that 401k. So ultimately, we want to work through in a plan, how much should we have Roth? How much should we have pre-tax? Pre-tax, we'll have to pay tax later when we withdraw it. Roth will be completely tax-free, but we have to work through that in the plan.
I really want you to think about Rothifying your life. Mm-hmm. Rothify to me is a word we make up, but it also means consider Roth every chance you get, no matter what income you're at. And the reason is that for 2024, 2025, we have the 2017 Tax Cut and Jobs Act tax brackets. Then it changes at the beginning of 2026, and they all come up.
Right.
Understand that you're going to pay more taxes just based on the law sunsetting. These are 2 great years to put money in the Roth. You need to do that.
Right. If you're in the 12%, they'll adjust it for inflation some, but generally that 12% will become the 15, and the 22% is going to become the 25, the 24 will become the 28. So we really are, these next 2 years, in this historically low tax realm where, we should be looking to Roth wherever we can.
So this word where do you put your money? Think about a Roth. Now, the Roth, when you put money into a Roth, like a regular Roth IRA, which we do for a lot of people, you have to make under a certain level of income to do it. If you make above that, there's a fancy backdoor way to get to a Roth, but that's not for this basic show here. But the idea of this Roth IRA, you put money in and it can grow tax-free, but you can also access the money you put in anytime we need it. But you can't take the growth out until you're over 59 and a half. So it is money being thrown to your future, but don't think that it's money you can't ever touch.
Right. Yeah. It's after tax in that nature, but and so you have the flexibility to use it kind of like another savings if you needed to pull the contributions out early. But generally, when we're saving to a Roth IRA, we want that to be retirement money.
Absolutely. And then we also add on, because people can't always, if they max at work, they might need to save more money, or if they're younger, they want more flexibility. And the use of life insurance and cash value life insurance can also lead to tax-free retirement, tax-free withdrawals for the big moments in life when you need a lot of money, or people want to retire early. This cash value life insurance can be a tool that works well if properly designed, and that's something we also do for some people.
Right, and that whole concept of properly designed is so important. If you go to the wrong person, or maybe specifically a life insurance person, they may try to fit life insurance where it's not necessarily needed.
Right.
It's almost like I think of it like with a toddler, they have that game that they try to plug the different shapes in.
Yeah.
And it's trying to plug a triangle into a circle where it's not necessarily needed. And so what we try to do is, by working with us and working with somebody who's licensed to use whatever products are out there, we can make sure we use those specific different investments, whether it be stocks or life insurance or bonds, ETFs, mutual funds, whatever it may be. We fit that into the plan. That's so important.
That plan is your plan. That's the key thing here is this. Investing, 4 principles of investing, understanding why and the purpose that you need to put money away. Second thing is where. Tax, pre-tax, put money in the bank account, money that's liquid that you can get to. It's all about timing, time horizon, risk. All this works together to give you the proper planning. Now, the topic of Roth and Rothifying has this saying that goes with it. That's pay tax now and never again. My retirees that have Roth IRAs, they have a bucket of money we can access anytime they want. They call and say, hey, I want to go to Europe. Hey, I'll send $10,000 for you. Oh, there's no tax on that. Really? How's that? Remember you did a Roth a decade ago? Well, we're taking some of the winnings off of that, and you're going to Europe for that. Mm-hmm. So that's just an example of something that we've done recently where we took some money out of a Roth just to meet that need.
Yeah, that's a great example, and it happens all the time. And that situation, it happened from that decade ago plan where you decided to set away some money that grew for you over the past 10 years so that you could use that money tax free.
Absolutely. It's very, very, very important. to put a plan together that is based on where you are now and where you need to be. So the why and the where all comes together with proper planning. That's what we do at Akers Financial Group. Everything we do is going to be about you when it comes to building a retirement that's as unique as your financial fingerprint. Imagine you come in and you talk to us and you bring this information, and then you start thinking and you start getting motivated about, I can actually make a better financial life for my family. That's what planning does. Financial planning is guiding you through this. It can be easy because you allow us to do it for you. It's like you bring in an expert, you bring a coach in, and they handle it for you. Remember that at Akers Financial Group, it's not about us. It's all about you. So go ahead and sign up for a free time with one of our team of advisors where we can talk about your exact situation. So give us a call at 833-WIN-RETIRE and schedule that free in-person or Zoom meeting with one of the team of advisors at 833-WIN-RETIRE. That's 833-946-7384. Or visit our website at akersfinancialgroup.com. Scroll down to the bottom of the homepage and schedule a meeting right there. Call 833-WIN-RETIRE or go to akersfinancialgroup.com. What investments are best for you? Stocks, index funds, CDs? We'll give you some direction to help make a decision on investments in just a moment.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Welcome back to Winning in Retirement. I'm Brian Akers from Akers Financial Group, and here with me today is Paul Franco. We're both financial advisors from Akers Financial Group, and we have Paul Franco, who has been working with me since 2017. Got his MBA in the pocket, and he's a financial expert from our offices and has done a great job with working with our clients, developing their financial plans. That's what all of us do for our people. We put together this show today, Paul, called 4 Principles of Investing. We're trying to keep it a little basic, but motivational. So how do you feel about this, Paul?
Yeah, this is the third concept called the what. And so this is
what?
Yeah, what?
We did the why and the where. Now we go to the what.
Yeah, this is one that I know a lot of people are really zeroing in on because it's so important to know what types of accounts to save to and, why you're saving to an account. But a lot of people want to know what to buy.
That's why they listen to TV shows, radio shows. Hey, what should I buy now? And a lot of that mindset is geared towards getting rich quick and trying to make money fast, which I want that the first premise to be that's not what we're trying to get you. The idea of getting rich quick versus being wealthy. The wealthy is going to happen over time if done properly. It's not quite a no-brainer, but it's mathematical. It's a process that works. Clients that do this over time become wealthy. Not this, let's try to get rich quick. Let's get wealthy over time where the money will be there so you can be financially independent later in life where you can work when you want to and you can stop working whenever you want to.
Right. Yeah. It's this idea of compound interest. It's not a get rich quick scheme. A regular market rate of return, it takes about 10 years to double your money. Yeah. So, that's
I like 7 years.
Yeah. Well, depending on the rate of return you're going for, but that idea of that rate of return and that really governs how to invest it. If we're buying stocks versus, CDs or annuities, anything like that.
Yeah, so the idea is this. If you think about the compounding, it's hard to go from $1 to 100,000. It's actually easier to go from 100,000 to 200,000 than to go from $1 to 100,000. And the reason is this. Imagine 100,000, if it doubles, it becomes 200,000. $1 doubles becomes $2. A doubles becomes $4. $4 becomes $8. It's a slow run getting to that first 100,000 for people. Imagine if you keep adding zeros. All of a sudden you had $1 million or $2 million and it doubles. It goes from 2 to 4. And so what's the amazing thing about our clients, they see that 2 to 4 double, and that's the normal pace that we've been going on. Nothing new, nothing fancy, but that normal pace of growth. If you're 7% a year, you're going to double in 10 years. If you make 10%, you're going to double in 7 years. Right. Imagine if you were at 8 million and it doubles. A straight double, 16 million. Mm-hmm. These are the kind of numbers that can blow people away when they think about it, and they think that's not really their reality. But I'll tell you that it is the reality of some of our clients. The fact that compounding works when you give it time and you put that money in and you stay with the stock market. So when it comes down to what to invest in, We want to talk about stock market investing versus leaving your money in the bank or in bonds. Those are major choices when people begin, is what level of risk to start at. So what investments are best for people, Paul, and how would you guide someone to figuring out where to start?
Yeah, it's a lot of times working through a plan for somebody. I know we mentioned the importance of getting started, but a lot of times we get people getting ready to retire in the next few years. They've built up very sufficient 401k balances. They have some sort of savings just in general by having a 401k invested in a broad stock market index. So now you're at $1 million, $1.5 million 401k balance. And it's like, what do we do now? We can't take the risk of being in the market to try to double that again if we're retiring in the next 2 or 3 years. We do have to scale down the risk into something that's more stable value oriented. We are limited with what we can do in a 401k, but it's so important to scale down that risk in an overall plan.
Yeah, and that leads to making wise decisions for what you're investing in. So let's use a 401k, and let's use the 401k choices. So you get your menu of choices, and what's the things that they try to push in the 401k plans?
Yeah,
Paul?
they typically push target date funds, and those are basically rules-based indexing where you own a stock piece and a bond piece, and depending on how far out the year is on that target date, you're going to own more stocks than bonds. As you get closer to that target date, if you're in a 2025 or 2030 fund, it's just a rules-based index. It sells out of the stock side and buys bonds. And that's kind of, regardless of the environment that you're in, it just does it automatically with this concept that as you get older, as you get closer to that date, we need to take less risk. We don't typically recommend to go that route, Brian. Is that fair to say?
Yes, and there's one basic premise in that target date funds. The idea is to go from risky to lower risk. We want you to go from risky to no risk. If you put your money from stocks to bonds on an automatic basis, you're buying risky investments, lower risk. But that risk, if interest rates do go back up, you lose money, actual money. And so the idea in a target date concept, part of it sounds good. You plug and play, you don't worry about it. It diversifies people in a great way. But you're subject to what that company wants you to put your money into. We've seen some target date funds with 30, 39% international exposure.
Yep.
We've seen someone in their 20s having money in a money market and a bond and an intermediate bond fund. And right. My answer is that is totally wrong for that 20-year-old, that early 30-year-old. Let's pick the fund. So when you look at your 401k menu, there's the target date funds, and you go past that, you'll see the actual funds, they have choices. Most funds have very, very few choices, but they usually give us large cap growth and value. They give us mid cap, small, and some international and emerging. They give us the bond side and stable value. I generally want us to think about just stocks. So buying money every paycheck into a volatile market is actually a great technique called dollar cost averaging.
Yeah. It's especially, and I just had a case like this where I have a client that's getting ready to retire in 3 months, and she's ready to go. There's no going back, and she's got all of her 401k in this target date fund, and it's a 2025 target date fund. Mm-hmm. So in reallocating that account, the idea is that for future contributions, we only have three more months, so right around 6 more paychecks. We can keep those contributions in stocks, but we have to do something with that current balance.
The nest egg.
Right. Exactly. The big nest egg. We need to make sure we move actually a big chunk of that to a stable value fund, something that's completely risk-free. Because like you said, Brian, that concept where on a target date fund where you own bonds, I mean, we just saw this, in 2022 where in target date funds, you basically, as you get closer to that date, they're selling stocks while they're down in 2022 and buying bonds because it's a rules-based index while they're down further in a rising rate environment. And that's not something we agree with. And if we can look at the choices that are in the plan, help us, let us help you make those decisions so that we don't have to do a rules-based type of strategy like that. And we can pick the different choices.
Because once you're 59 and a half, you get to decide where you want to put your money. In most plans, what that means is you can move your existing 401k plan as a rollover out, and you can diversify into anything that's out there. You can make your protected money be absolutely protected from downside through proper design and using different investments. You can also make sure investments are more broadly diversified into areas that 401ks don't have, like real estate, precious metals, commodities. There's lots of different choices to lower the overall volatility in your portfolio design by actually investing that money through a money managers like we do at Akers Financial Group.
Yep, and absolutely. And we use annuities as another way of using risk-free a portion of money. This is not variable annuities that have high fees and are tied to the market, but we use fixed or indexed annuities that are protected from any market downside. And we use a mix of CDs and treasury bills, something that's been yielding higher interest in this rate environment we're in now.
Yeah, so that we use a combination of laddering, meaning laddering is a time-based laddering, 1, 3, 5, and 7. We're not really going further out than that in the annuities or treasuries or CDs, anything like that.
Right.
We're staying on the short term on that. We do love the rate of 5%. We like locking that in if we can. We think that's a decent rate for what's going on in the next couple of years here. We do believe that we got to watch what we invest in. I know if it's a taxable account, we like to use exchange-traded funds, things that'll be more tax efficient than possibly a mutual fund.
Right.
We like mutual funds with great managers, especially for retirement accounts, but not always the best for taxable accounts.
Right. And for higher income or higher net worth individuals, we may use municipal bonds to have tax-free on the federal and state side. But it's so important to look at what you own because, you don't want to own a municipal bond in a retirement account, right? It's no benefit to you.
But we see cases when people bring their money over here. It's just not done real well. A lot of times inheritance, you inherit money from an 80-year-old person, comes to your account, and that a broker just moves it over and plug and play. You're in the same investment as your 80-year-old grandmother, and it might not be the right thing for you. You have to readdress and change the portfolio.
Yeah. Absolutely. It's so important to fine-tune that portfolio for somebody who's in their 50s or 60s versus somebody who may be in their 30s or 40s.
So typically when you're looking at investments, you want to have money protected and liquid. That would be money for short term. As your time horizon gets wider, you can add more risk to it. You can look towards growth and liquidity. It can even be longer term. So the why, it's building your goals. And then where, is it retirement based or is it more immediate based, how you want to title it? Once you get the account, inside the account, you can really invest in anything. And that's how we try to implement planning by choosing the investment to tie to the proper where, to the proper investment inside of there. We love Roth IRAs to be more aggressive. We like younger 401ks to be more aggressive because we want to keep buying that market. This is all about your retirement because the best part of retirement is going to be when you get your time back, where you decide how to use it. Before retirement, your time is tied up with other commitments, mainly your job. A lot of that goes away in retirement. Your time is now consumed by things that you want to do. It's so easy to begin winning in retirement. Go to our website at akersfinancialgroup.com, scroll to the schedule meetings section, and let us know you'd like to schedule a free consultation with one of our team of advisors. That's akersfinancialgroup.com, or give us a call at 833-WIN-RETIRE. That's 833-WIN-RETIRE. We'll give you a call on Monday to schedule your free in-person or Zoom meeting. Go to akersfinancialgroup.com or call us at 833-946-7384 to start planning for your retirement now. When should you invest the money you have set aside? We will explain when we return in a moment.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Welcome back to Winning in Retirement. I'm Brian Akers, and today I have with me Paul Franco. We're here in the fourth quarter. Fourth quarter is winning time.
That's right.
And it's winning in retirement time. Winning in Retirement Radio Podcast. We welcome you to our fourth quarter. Yes, we need to fix everything, understand everything, get everything out all here in the last quarter. There's so much pressure, Paul. You ready to go?
So much pressure, and everybody's got to be ready to listen to this.
That's true. Today's show is about what kind of 4 principles of investing, but what are the 4 W's again, Paul?
What, where, when, and why. And not in that order.
So what order have we done them? We did the why first, right?
Why, where, what, and now we're talking about when.
All right.
When is to invest the best time.
All right, so when as in W-H-E-N, not W-I-N, like in
Right.
retirement. It's when.
When in retirement.
All right, so the question for the quarter is, when should you invest the money you have set aside? How does anyone decide when to start?
Yeah, generally the idea is to invest today. Really, the idea was to invest yesterday.
The idea is once you invest your money, whenever you got it, when you got that money, put it aside, let it go, let it be invested right away. Don't let it sit making zero. Make that money work as hard as you do. Make it work 9 to 5,
Yeah, and that's circling back on what we talked before about, that's this idea where we have these different buckets, short-term, mid-term, long-term buckets of money. And the idea is, yes, we invest now, but then we go back to the what. What do we invest in? And so then we work that into the plan. If it's shorter term, let's buy something higher yielding. Is it longer term? Let's buy stocks. Let's buy, some sort of large cap, have some sort of mix of stock fund where in the future, we're going to get that good rate of return for that longer term bucket of money. But the idea is that you do it today. If you have it, let's work through the plan today and try to work through how to do it best.
One of the best things that's happened to me is I've been in the career a long time, like 36 years. So I've gotten to see what has worked and what kind of habits work. The general habit of putting your money aside and letting it grow, investing in the stock, well-managed stock funds, stock managers, stock portfolios, and letting it go up and down. When things look bad, you add more money. When things are going crazy, you readjust, make sure you properly allocate it, but you don't sell at the high or at the low. You just let that money keep going over time. Yeah. And then before you know it, that compounding really takes effect. When people add market timing into the investments where they're trying to buy in and sell and trade constantly, all of a sudden they achieve lower than market returns. They get less and they don't get the compounding. They end up, like when the market goes down, they wait for it to go down, then they sell out. And then the market's down. Then when the market starts going back up, it gets way past where they got out at. Then all of a sudden they get back in at the high. It's bad habits that affect people's money. The good habits are people that save that money, invest that money, and they stay with the plan, and they don't let the emotions change their plan.
Yeah, and it's so psychological, Brian. Like you said, it's when the market's down, we get so many, I need to get out. I need to move out of these funds and buy something safe. Mm-hmm. And then when the market's, at an all-time high or close to an all-time high, it's, now I should be buying in now, but it's actually the flip of that.
Well, the market's done incredibly well the last 3 months. Let's buy more of it.
Right.
This stock is at its all-time high. I want more of that. And the answer is, why is it its all-time high? What's its valuation? Is it really the best thing to buy for you, or is there something else? The hardest thing to tell people is to stick with what they have. We do get those phone calls. Sometimes we get those phone calls and we know that the market's going up the next day because there are certain clients that worry a lot. And whenever things are going down, they'll make a phone call and we have to say, please stick with us. This is all part of your plan. We don't have all your money at risk. We have it balanced out. You need to stick with the stock portion because it'll have a great day. And then all of a sudden the market roars back up and they, we should put more money in it. No, we're not going to do that either. We can't do all or nothing.
Right.
We got to build this portfolio and diversify.
Right. And that's that idea where a lot of times that call comes from somebody gets a statement from their, stock account, that the at-risk portion.
Yeah.
And it's, let's circle back and look at the overall portfolio and see how much do we have at risk versus how much do we have protected. If that balance is sound and there's no change to be made there, then the idea is that, yes, we want our at-risk portion it will have volatility. There will be up and downs there, but we want to keep that there. And there are so many studies out there that show that just staying invested over a long period of time results in a higher rate of return. I've seen multiple ones where if you miss the 10 best days over a 20-year period,
yep. If
you look at the balance of that account versus if you just stayed invested in that same time frame, it's significantly less.
Absolutely. There's this, if you type on the internet, Louis the Loser, there's this demonstration of Louis the Loser bought a stock market investment every day at the high. Every year at the high. And then they still did extremely well over time because they invested in stocks. The idea is this: the longer term, we do want to buy stocks. We do want to buy portfolios and design those portfolios that are well managed to track the companies, make sure they're all doing well, building your model for you over time. The idea of what stock portion you have, you got to stick with it and keep that proportion going. When we get closer to retire, we can put new money and lower risk and try to dial the risk down overall because we don't want to have the volatility as much. Volatility, you address your volatility on your investments by adjusting how much is in stock, how much is in the protected side. We're not a fan of target date because if you're older and you put in bond funds, interest rates go up again, you lose your money. Every time you've seen a major collapse in the stock market, alongside that has been a bond collapse. Back in 2000, 9/11, when that occurred, bonds went down. 2004, 2007, 2008, 2009, 2000, all these different times, the bond market lost very quickly, as fast as stocks. And so was your protected money safe during that time? No. And we got to build that especially for our retirees, so they can win in retirement where they're not worried about losing it all.
Right. And somebody might be listening to this that has that exact situation where they've saved over this long period of time, and they have built that sufficient and strong nest egg, and they don't want to lose that now. And so that's why it's so important to work with a financial planner and make sure that we have the proper allocation to something that's truly protected, not like a bond fund that can, yes, you collect a coupon and yes, it's lower risk, but in a rising rate environment, those can lose value, those bond funds. So when we make a portfolio, an overall portfolio, to have some at risk and some protected, we want our protected piece to be truly protected, cannot go down with the market.
All right. So the question is this: when should you invest the money you set aside? So let's say people have excess money in their bank savings and they have enough for emergencies, they paid off all their debts, and now the plan says they're ready to invest and their goal is more like 5 years or beyond. Is it time to invest in stocks when it comes to that?
I would say absolutely yes. In that situation, that's why though we talk about that, case by case, where depending on your risk tolerance, and everybody's going to have a different risk tolerance, and depending on the time frame that we need that money, the argument is, one, yes, it's time to invest now, but then two, then we work through how to invest it from there, not just keeping it in a regular savings in that particular situation.
Yeah, that makes sense. I guess some of the hardest parts when it comes to people investing is getting them to a point they understand what they're buying. It's weird in that some people come in and they've had portfolios, like it's sort of a progression. They go to their bank, then they start investing through their bank, and they're not really sure what now they're in. And then we have to educate them on what they own or what they've bought over their lifetime. Then we bring it all together into an overall portfolio review, and we look at where all these buckets of money are, and we say, well, is this what you want? And they go, oh, no, I don't want that risky. I want to have an adjusted risk. And so we then have to build this portfolio back out and take our time developing their right answer based on their history. So it's not quite as easy as fresh money that you can just buy.
Right.
But a lot of times people have this history of jobs, of ways they've saved through different companies. They build a collection of investments. And we like to bring it all together in certain ways, using the why we're investing, using the where with the Roth, the IRA, the taxable, the college funds, all these purposes, and then what to buy based on what they already own and paid fees for, and what's the best thing to buy next or to hold what they have. And then when to do all this, and that's what we call planning. This bringing it all together is a process to fix and change and get everything organized in a proper way, from our opinion.
Yeah, and that's a first and second meeting where we really zero in on what do you own. There may be pieces that we don't need to change, and that's perfectly fine. But it's so important to look at your overall net worth, look at where your accounts are, and see what you own, and evaluate the risk that you're taking and whether you want to take that risk.
Absolutely. So investing from the why to where, into what it should be, and to know when is the key to this process of actually investing for your future. There's this comment called yo-yo. You are on your own. Consider that only you will be able to throw money towards your own future. So this 4 principles of investing, Figure out what your purpose is with your money. At least have a beginning of this, and then let's begin to talk together through a free time with our advisors, with one of our team of advisors, right, Paul?
Absolutely. Yep.
And so they sit down, they talk with you. Is it you're going to you bite, or do you?
I don't bite, but I ask nosy questions, and that's, I think that's a good thing, because what we want to know on our end, we want to make sure if we're offering advice, we're offering the best possible advice, and that's knowing where all the accounts are, knowing what what goals you have, and so that's ultimately going to guide us in the advice that we give.
Now, that might sound overwhelming, but it can go at your pace. It doesn't have to be,
Absolutely.
let's do everything at once. It's the pace is more about comfort level of what your goals are, the why, and then we build where everything is and bring it together, and then we figure out what to do, and then we implement that, and you become a long-term client. That's truly what we're looking for at Akers Financial Group, is that long-term financial advisory relationship, managing money, finding the best insurances, bringing it all together to implement proper tax advice, everything all together in one place.
Yeah.
And that's what we're trying to do, right, Paul?
Absolutely. And that, I mean, generally that first meeting is always just kind of getting to know each other. And in some cases we talk about finances, but it's really just getting to know what the goals were, how you got to where you are now, and what you want your future to look like.
No matter how complex you think your situation is, we can be there to help and guide you to that next step, whatever that next step may be. Thanks, Paul, for a great show. And thank everyone for listening to Winning in Retirement this week. We want you to win in your retirement by taking advantage of the opportunity to begin planning with us at Akers Financial Group. To schedule your free meeting with one of our team of advisors, go to our website at akersfinancialgroup.com. Scroll to the Schedule Meeting section and let us know you'd like to schedule your free meeting. That's akersfinancialgroup.com. Or give us a call at 833-WIN-RETIRE. That's 833-WIN-RETIRE. We'll give you a call on Monday to schedule your free in-person or Zoom meeting with one of our team of advisors. Start planning for your retirement now. Go to akersfinancialgroup.com or call us at 833-946-7384. Thank you for listening. I'm Brian Akers from Akers Financial Group, and we want you to be winning in retirement.
You've been listening to Winning in Retirement with your host, Brian Akers of Akers Financial Group. Akers Financial Group offers securities through Archedios Capital, an SIPC and FINRA member firm. Advisory services are provided through Archedios Wealth. Akers Financial Group and Archedios do not share any common ownership. Neither Archedios nor Akers Financial Group provides tax or legal advice. Advice given on Winning in Retirement is general in nature, and one should seek further advice from their financial advisor, broker, attorney, and or tax accountant before investing. Be sure to read each prospectus carefully to understand all the risks associated with each investment. Examples and scenarios shared are meant to be for illustrative purposes only. Past performance is not indicative of future results.